Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. This is another Q&A. Appreciate it. I see a ton of people in the chat and asking some great questions. If you can give me a thumbs up if you can see and hear me. If you're new to all of this, there will be timestamps that I'll put below the video because this will be a 2-hour video. It takes about a day to get them up, but they will get there. And if you want me to cover a topic, just tag me in the chat. Thanks for the thumbs up. As I mentioned, I'm going to start as you can tell from the title of this, I'm going to start with Roth conversions because they've been on my mind a lot. And I've been planning a Roth conversion video, which I will do, but I've been held up because I hadn't figured out my own strategy, quite frankly. And so we're going to cover that for a few minutes, then I'll get to your questions. I should say, I've never considered myself as someone who is on the cutting edge of fashion. But someone did ask me where I get my shirts from that I wear on the show, and untuck it. They're all untuckets. I just like them. I don't like tucking in. I like untuckets. This one's my least favorite for reasons that would not be obvious. It's too heavy. I like their silky kind of. It's not silk, but it's got it's a mix that's just, I think, it breathes. That's what it does. This one doesn't breathe. I feel suffocated in this one. Anyway, yeah, so Roth conversions. So here's the deal on Roth conversions. There's two ways to convert. So first of all, I'm not talking about a backdoor Roth. I'm talking about, you've got before tax, let's say IRAs, maybe you rolled them over from a 401k, but any conversion you do, you're going to pay taxes. So that's what we're talking about here, not a backdoor Roth or a mega backdoor Roth. And there's sort of two ways to go about it, right? You can do the conversion and pay the taxes out of the IRA. So for example, let's just assume you convert 10,000 and it triggers $2,500 in taxes. You pay that out of the 10 grand and you end up with 7,500 in a Roth IRA. Now, of course, if you were going to do that, you'd want to make sure that you don't get hit with 10% penalty because, you won't for the money you put into the Roth, but if you're taking 2,500 out to pay taxes, and you're not 59 and a half or older or have some other exception to the 10% penalty, you'd pay a penalty. So, but maybe you're in your 60s or whatever, you could do a Roth conversion, pay the tax out of, in this case, the 10 grand, and you'd have 7,500 left in the Roth. That's one way. The other way, of course, is to pay the tax from whatever, a taxable account. So just imagine you've got 2,500 bucks in your checking account. You convert all 10,000, you put all 10,000 in a Roth, and then the $2,500 you pay out of your checking account. So those are sort of the two approaches. And the difference is important because here's the deal. If you pay the tax out of the IRA itself, then whether or not the conversion is a good deal from a tax perspective depends entirely on the taxes you pay at conversion versus the taxes you would have paid down the road, whenever that is, when you would have taken the money out from the traditional IRA had you not done the conversion. Whichever tax rate, and I'm using the term tax rate very loosely for a moment, but whichever tax rate is lower is the winner. And it's extremely difficult to know what the taxes will be in the future for a host of reasons. We don't know what the tax brackets are going to be. You might not know what year you're going to take it out. I suppose we could look at RMDs, and we'll talk about that, but as when you're going to take it out. But, I'm in my 50s. I don't know when I'm going to take it out. If you're getting Social Security at that time, either at the time of the conversion or if you didn't convert when you took it out and triggered taxes then, it could increase the amount of your Social Security subject to taxes. If you're at the right age, it could increase, because of IRMA, could increase the premiums you pay for Medicare. There's always the net income, the net investment tax, the 3.8% from the Affordable Care Act, which could affect you on either end or both, right? And there's other things. A spouse could die, right? And the year after the death, you're now a single filer unless you remarry. Or your spouse is the single filer unless he or she remarries, and all of a sudden their tax brackets are completely different than what you planned for. And then of course, there's the whole question of how your investments will perform, because that's going to determine how big your traditional IRAs are when you start taking required minimum distributions, which will affect how much you take out. I mean, the list of uncertainties goes on and on and on, and I'm sure there are many others that I just haven't mentioned this morning. So that's what sort of got me flummoxed, I guess. I couldn't figure out my strategy. I finally figured it out, and I'll share it with you. So here's the deal. If you pay the taxes from a taxable account, then how long the money stays in that Roth IRA, assuming we convert, matters. If you pay the taxes out of the IRA, it doesn't matter. It's going to be whichever tax is higher at the time of conversion, or when you took the money out of a traditional IRA. You could convert and leave your money in there for 50 years. It still doesn't matter. It's whichever one was higher wins. But if you pay the taxes, say from a taxable account, how long that money stays in your Roth IRA matters. Every year it stays in there, and the value of that Roth IRA goes up. Remember, we want our Roth IRAs to be as fat as a tick. You get a little extra advantage such that you could actually pay more in taxes at conversion than you would have had you not converted and took the money out whenever in the future, and it'd still be a better deal. Now, of course, that raises a question. Well, what's the math behind that? And how do we figure out, just how, for each year I keep it in there, what the benefit's going to be? And there's actually a paper on that, and I'll pull all that together for my video, which I hope to record next week on Roth conversions. But the real takeaway from our perspective is that if you pay the taxes out of a taxable account, I kind of look at that as giving you a margin of error, because what our taxes are going to be in the future are at best a guess anyway, right? So, and you might say, well, why is that? And if you think about, imagine we've got $2,500 in a taxable account, 10 grand in a traditional IRA. If we pay the taxes on a conversion out of the IRA, well, we still have 25 in a taxable account, which we can invest, fine. We take the 10 grand out of the traditional, we pay 2,500 to taxes, and we put 7,500 in a Roth, right? So we got 7,500 in a Roth, 2,500 in a taxable account. Now that same scenario, but we use the taxable account to pay the taxes. Well, now we have nothing in the taxable account, right? We've spent it on taxes, but we have a full 10 grand in the Roth. So the net effect is, by paying the taxes out of the taxable account, we're able to take that amount, $2,500 in our hypothetical, and effectively put it into a Roth. And that's the difference. Watching $2,500 grow in a taxable account, which will be subject to taxes each year, say for dividends, if it's in a low-cost index fund, plus tax on the gains once we sell it, right? Versus in a Roth where there are no annual taxes, and assuming we follow all the rules, is tax-free when we take it out. Well, at that point, how long we keep it in the Roth matters. But actually, what really matters is how much it grows. That's what really matters. But we can think of that in terms of length of time. The longer it's in there, the more it'll grow. So all of that is like, you might think, Rob, that's just great. It's early. I haven't, I've had a cup of coffee, but whatever. Okay, that's great. Appreciate that. Now what? Well, the now what for me was this, that I want to try to do my best to figure out what my tax bracket will be at RMD time. So how do I do that? Well, I've got to figure out how much I'll have in traditional accounts by then. So I've got to make assumptions about how, growth, right? I've got to make an assumption. But I'll make it, and then we can calculate, what our RMDs will be, and we can make an assumption about tax brackets. And what will my top tax bracket be? Now, again, as I've said, there's, whether a conversion or a distribution, it's not just your tax bracket that matters, right? There's all these other things that that a conversion or taking money out because of RMDs can trigger other taxes. But I'm keeping it simple at the moment, just focusing on tax bracket. So how do we do that? Well, the way I do it, and this is a demo account, but I'll just show you, it's new retirement. And the more I learn about this tool, the more I like it. But I want to just show you a couple things. So I'm actually going to go, this will actually work out good. So I'm in new retirement, you list all your accounts. You can actually connect them if you want, but I don't think it's necessary here. This is not like personal capital. This is not going to give you detail into your asset allocation and your expense ratios. It doesn't do that. So you could just at a high level, at an account level, put in each account. Right? One of the things you have to do is put in an optimistic rate of return and a pessimistic rate of return. And when I first started using New Retirement, that really kind of annoyed me. I don't know. For some reason, I thought they should do that. But then I thought, well, how are they going to do it? What's their assumptions going to be? And the thing is this is at an account level. And that kind of annoyed me too. So at first, and again, this is a demo account, but in my account, I just put the same optimistic and pessimistic rate of return across all of my accounts, taxable, Roth, traditional. But that didn't make sense because, I look at asset allocation across all of my accounts. So I have a lot of bonds in my traditional. So their expected rate of return is lower than what my Roths or taxable are going to be. And then I realized how important that was because, again, what we assume here is going to affect the Roth conversion analysis. So one of the things you can do, and I know this is getting into the weeds a bit for a Q&A, but I use this as just an example. I put in Portfolio Visualizer a portfolio of 80% total bond market and 20% emerging, which is a very odd portfolio, but this is actually not unlike what some of my traditional retirement accounts look like. Again, I've got, I do asset allocation across all of my accounts, but in an individual account, this might be the actual allocation for me. And if you analyze that, and then I go to rolling returns, you can see the rolling returns of this portfolio. So one idea I had was to use this to estimate my returns for New Retirement. And now I would probably make some adjustments, right? Because this is from 1995 to 2022. And we all know bonds have been in a huge bull market, meaning prices, yields have been going up as prices go down, and maybe we're now reversing that. But I might take a look at this and say, okay, you know what I'll do? I'll make the 10-year low my low. I'll make the average my high, my optimistic. I haven't settled on this, but that's sort of the concept, right? You could use 15. I think that being the low, 4.52%, given where bonds are, I probably would have it lower than that. But the point is, you can use Portfolio Visualizer to at least have a guesstimate of optimistic and pessimistic returns per account, all right? And one of the things it does, as you can see over here, and I can try to make this a little bigger, maybe, I don't know. It shows you your tax brackets. Now, yours would look different than this. It's just because it's a demo account. But this right here is when RMDs kick in. And you can see, at least in this hypothetical, the top bracket's 28%, right? That's the red. Now, if I come over to assumptions, you can see I'm assuming average. If we go to optimistic, it goes up. The tax bracket's 41%. And I'm still inquiring with New Retirement how they calculate 41%, because it could be factoring in other taxes like that 3.8% Affordable Care Act tax. But the point is, what we assume here, optimistic, average, or pessimistic, go to pessimistic, it really changes things, right? Just 14%. So this assumption matters. I'll probably use average for my assumption, but again, you see the trouble with Roth conversions and trying to project out. But part of my thinking is I'll likely never spend the Roth money, or if I do, it won't be for decades. And so if I'm paying the taxes out of a taxable account, that gives me a fairly wide margin of error over time. And all of this assumes that, our government doesn't raise our taxes. All right. So where I'm left with after all of this, and thank you for your patience, is if I can convert in the same tax bracket that I think I'll end up in retirement, I'll probably convert. I'll always look around and say, before I do, what other implications are there for my taxes in the year of conversion, like the 3.8% Affordable Care Act tax? But again, I could hit that in RMDs as well, right? But I'll always look around. I won't just rely just on tax brackets. But if I can convert in the same tax bracket that my RMDs would kick in at, I'm likely to convert, again, subject to all those other scenarios. And the theory is I'll have a lot of time for it to grow in a Roth, which will help me. And all of this assumes no increase in tax rates. I think New Retirement builds in the 2026 increases when the current law expires. But I mean, beyond that, they're not trying to guess what Congress is going to do. How could they? And so that's I'm fairly comfortable with that. Now, I will tell you, I'm actually asking Schwab to run an analysis for me, the software they use is called Money Guide Pro. And I'll let you know what they come up with. So that's very quickly and at a very high level, my thinking on Roth conversions. You're probably sorry you asked. All right. Actually, you guys didn't even ask. BJ's back from Ann Arbor. He says he has a love-hate relationship with Roth conversions. I mean, there could be situations where it's very easy. You retire at 50 or 55, you have no earned income, you have maybe a little bit of dividends and interest, but you can convert, in the 10%, 12% bracket. And RMDs are going to be 22, 24% because you're a boss and you've saved a lot of money. It doesn't, you don't need a lot of fancy tools to figure that out. But beyond that, it can be really tricky. All right. Scott, thanks for the kind words. So Marv wants me to discuss the pros and cons of a reverse mortgage. And the truth be told, I can't, not really, because I've spent no time studying reverse mortgages. I mean, I understand what they are. And, I do know that one big negative, it potentially are fees. Obviously, a positive is a way to get cash without moving out of your home. But I will work on that topic because it is an important one. So Paul says, can you discuss if there is a minimum below which a Roth conversion doesn't make sense? Say $999,000 in deferred accounts, retiring at 61 with 30,000 pension, staying in 12% tax bracket until Social Security at 70. Well, I don't know that there is a minimum below which it doesn't make sense, and I'm not sure what you mean by minimum. Minimum of what? The thing that I would look at, Paul, is what your RMDs are going to be. Kind of what I just walked through. And again, it's at best a guess. But what are your RMDs going to be? And what bracket will they put you in when you add in Social Security and any other income you have? You mentioned a pension. I don't know if it's taxable or not. Are all pensions taxable? I'm not even sure. That to me is the analysis. That's the question. Yeah. By the way, another factor, will you make qualified donations from your traditional to soak up some of your required minimum distributions? Because we probably will. Right now, we contribute appreciated stock to a donor advised fund. I'm pretty sure you can't do a qualified donation out of your IRA to a donor advised fund. I don't think that's allowed, but you could give direct to qualified charity. Charles Woodson is back. So the last time Charles was here, I asked the question, is he the Charles Woodson? And I think I made the mistake of saying that he played for the Steelers, and I don't know why I think that, because he played for the Raiders, I think, right? Anyway, don't even know if it's that Charles Woodson. Okay. 10% of my 401k is in, and he gives a ticker. And I've never heard of the ticker, so let's check it out. Really? This is interesting. Buffalo Early Stage Growth Fund. All right. And it's got a big negative. What's that all about? No idea what this is. I want out due to high fees, but fund is down 30% from November. Should I ride out volatility or sell low and in theory buy another fund? Well, it's in your 401k. So one way to think about, boy, it is expensive, isn't it? It's 1.51%. High turnover, which doesn't affect taxes since this is in your 401k. It could affect transaction fees that the fund passes on to you because they're not included in the expense ratio. What is this portfolio? Anyway, to answer your question, the way I think about it, so it doesn't really matter what's happened in the past. The fact that you're down 30%, it's in a 401k, so there's no tax issues, no tax loss harvesting if you're at a loss, no worries about gains if you're still at a gain. I know that we often look at like buying the dip, right? We look at recent price action to kind of get a feel about what we should do. But if we were really going to evaluate this or any investment based on price, we would compare price not to a month ago or 3 months ago or whatever. We compare price to its intrinsic value, right? Which can be hard to do for a fund. Certainly, you could look at valuation metrics like PE, and we can look at them here. I don't have any opinion on this data. I don't know anything about the fund. You could look at valuation metrics, right? And the question would be, is it under or overvalued? The tricky part about that is just because it's overvalued, if that were your conclusion, doesn't mean the price won't go up for a while. And just because it's undervalued doesn't mean the price won't go down for a while. But that's what you would look at. And that's what I would look at. It's very tempting. I'm no different than probably most people. I always, you see it go down, you hate to sell when it's just gone down. Maybe it'll go back up. And maybe it will, but maybe it won't. So if you've made some assessment that it's undervalued as compared to its, the intrinsic value of, the fund, then, that to me could justify staying in the fund. Although again, the expense ratio is astronomical. But I personally, I can't tell you what to do, but I would not stay in a fund simply because, what the price did over the last few months. Same thing with a stock. And it's tempting to do, I mean, a stock falls by 10%, it feels like it's on sale. But the reality is it may have been significantly overpriced to begin with, right? So if it's worth $10 and it was trading at 25 and it falls to 15, it's still a bad deal. At least that's how I think about it. Scott says he'd like to spread his play money into one individual stock in each of the 11 stock sectors. He looks at price to earnings versus, I guess, fair value price to earnings. I'm not sure. Price to book and dividends. Buy, hold, hedge strategy. Too many moving parts is his question. Well, I don't get into the sort of buy, hold, hedge strategy. And to me, that would require, I think if I read your comment correctly, 11 stocks, way too much for me, too many to evaluate, too many to keep track of. But in terms of valuation, where I've gotten now is I just wait. I like to invest in stocks that are so undervalued, I don't really have to do much analysis. It's I'll write a book, The Lazy Man's Guide to Stock Investing. And right now, there aren't a lot of those. So I'm not really looking at individual stocks to buy at the moment. But if I were, I mean, I would certainly, what I would look at, what's the value of the company based on its current price, right? And what do I think the value if I were going to buy the company whole, what's its value? How would I value it? So there I'd look at cash flow, some reasonable projection of future cash flow, and then calculate a present value of that. You could go out 10 years, calculate the present value of all that cash flow, and then you'd have some valuation for the company at the end of that 10 years based on maybe its average PE over a long period of time. And you can see that there may be other tools, but let me just show you in Stock Rover. This is just where I know you can do it. Let me pull it up and I'll show you. So let's just we'll look at Apple. And I think I go to chart. No, I go to table. No, it is chart. Okay. So here is Apple in Stock Rover. And this gives you, now this is based on 1 year. Can I go longer than that? I must be able to. But in any event, this has been the PE over 1 year. So it's currently at the low end. But again, that's just, and they call this the football field. And PE is just one of the metrics. I'm not sure how to, let me see if I can make that. Well, first I can enlarge it for you. And I know there's a way to make it longer than 1 year, but, oh, here it is, I think. Let's see. Oh, here we go. I just, have to look and read the screen. So if we go to 5 years, see now the PE is kind of in the middle. right? It's been as low. Look at that, as low as 11.9, and that's something. Anyway, so on the valuation of the firm at the end of 10 years, based on profits, I'd probably be more conservative than 28. Actually, I'd probably come in here somewhere. But that's sort of conceptually what I did when I first invested in Apple. When I invested in the banks a year plus ago, I didn't have to do any of that, really. I mean, they were just so clearly undervalued. Anyway, that's my take. Let's see here. Rap Freak is back. What are your thoughts on how to invest for college and the use of a 529? Ohio 529 is moving to Vanguard TEPs. I pulled those up. Vanguard target enrollment portfolios are kind of like target date retirement funds, but for 529 plans. So as your child gets closer to going to school, it changes the allocation. I haven't dug into the details of any specific one, but my sense is these would be perfectly reasonable. I did a video that you can look up on this, and I looked at Utah's 529 plan, which just has a lot of good information. But we can look at the Vanguard TEP. So you can see green is stock, blue is bond, and this is for an enrollment date of 2040. So someone, maybe a newborn. And then as you get closer, you can see the bonds go up quite a lot. What's the purple? Cash, maybe? Short-term reserves. This gets pretty well. I mean, I guess that makes sense for someone going to school in a few years. Yeah, all of this looks reasonable to me. We can pop into one and go to portfolio. Yeah, and it's just using Vanguard funds. All of that seems very reasonable to me. So actually, I think I have, once again, Ohio coming through. Hey, VJ, I bet Michigan doesn't do that. Okay. Okay. I'm gonna pronounce it. Tanua? I don't know how to pronounce this name. I would ask you guys how I should pronounce it, but you guys can't talk to me. You're no help. But they ask a good question. Love this show. What is a defined benefit pension plan? Can we set up our own defined benefit pension plan even if we are not self-employed nor own a business and are already enrolled in a 401k? So the short answer is I don't believe you can. I think you have to have a business. I'm actually Googling this. And I'll tell you what one is. You can be self-employed and set one up, right? But I don't think you can just set one up like, you work for a company, you're a W-2 employee. So there's defined benefit plans and defined contribution plans. And the idea is defined contribution plan is what you're used to, 401k, IRA, where what the benefit will be when you retire, well, who knows? But we're gonna set the contribution, and there's limits, right? So you know how much you can contribute. So the contribution is defined. What benefit it gives you, when you retire, who knows? With a defined benefit plan, it's the opposite. It says, okay, we're gonna come up with a benefit that we want to achieve when you're 65. We want to give you, and there's limits. You can't say, well, I want $100 million a year. So there are limits. But let's say you want 100 grand a year, just to pick a number, when you're 65, and now you're 55, okay, and you've got your own business. All right, so we can, with a bunch of assumptions, figure out how much you have to contribute to this defined benefit plan when you're 55, and you're going to continue to contribute to it, so that when you're 65, you'll hit that defined benefit. And of course, as we all know, part of that's going to depend on how the investments in the plan perform. And so every year this gets recalculated. And I had one when I had, before I sold my previous websites in 2018, we had one. And they're expensive. You have to have, a company set one up. Schwab actually has probably one of the least expensive, I'll show it to you, personal defined benefit plans. And you can see here, it helps self-employed and small business owners save for retirement, but it's not cheap. It's several $1,000s a year, as you can kind of see the numbers there. I can make it a little bigger, maybe. I did not use Schwab. I used a local company. But you can end up setting aside, well, in theory, 6 figures a year, tax deferred. The deal is you generally have to be 50 or older for it to make sense, and here's why. Remember, there's a limit on the benefit you can choose for when you retire. But let's say you're 30. Well, to hit that benefit, you don't have to contribute as much when you're 30 than you would if you waited until you were 55 to start this. And the amount you would have to contribute and be allowed to contribute, and it's a range, but at 30 wouldn't justify the defined benefit plan. You'd just be better off with a SEP IRA or a solo 401k, which wouldn't make sense. That's coming from me. I'm not a defined benefit plan expert, so feel free to reach out to one, if you want a second opinion. But I don't believe an individual can just on their own without a business open one up. If you have employees, it gets more complicated because they've got to be involved in it. So there are a lot of rules. But a lot of folks do this. There's like professionals, that own their own firm with no employees or few employees think, maybe, I don't know, a doctor's going to have a lot of employees, I would assume, but maybe doctors, maybe some of them. Maybe some of them are just a business on their own. Maybe if they work at a hospital, but they're technically a contractor. I don't know how doctors work anymore. I hardly ever see doctors anymore. I see physician assistants. I haven't seen a doctor in, well, that's not true. I saw one a few months ago. Before then, it'd been years. Anyway, hope that was helpful. Jim, I have 2 target date funds in my taxable account. I am retired and taking the dividends and gains to spend. Given my situation, is there a downside of leaving these funds in my portfolio? Well, Jim, we actually looked at this and I did a video. You're spending your dividends, and that's fine, but you could end up with capital gains distributed that you might not want to get taxed. That was the big issue with Vanguard last year. So that's the issue. Of course, there may not be an easy way to solve it. If you've got a lot of gains built up over the years, simply selling them to move them into some other kind of investment may not make sense either. But that's probably the biggest issue. There's another issue for me and why I would not put target date funds in a taxable account. Let's imagine you do that. You start investing in a taxable account in your 30s or 40s, and it's a target date fund, and you're dollar cost averaging, whatever. And now, before you know it, your kids are grown and gone. They won't call you. They don't respond to your text messages. Not that this is relevant, but they take your space heater out of your garage without asking you. Well, whatever. And now you're 65, and you've got all these built-in gains. Lots of gains because you've been doing this for a long time, and you realize that the asset allocation in your target date fund now, because it's changed, is like 20 or 30% stocks. And you're like, that's not what I want. Well, now what do I do? Now, the more and more bonds, those get taxed every year. Maybe not as big a problem in retirement, but could be, but you're spending it. But if you've got built-in gains, particularly for the stocks, how do you get out of that to get to something that's got an allocation that you want? Could be problematic. I really don't like target date funds in retirement in a taxable account. But Jim, so those are the issues. I'm not sure there's an easy solution, right? Depends on your tax situation and the gains in your fund. Okay. Scott wants to know, is there any reason why our government does not allow non-earned income, like Social Security, to be invested in a Roth IRA and increase the amount one can contribute as well in retirement? I'm sure there's a policy reason why they want earned income. I'm trying to think what that might be. I don't know off the top of my head. Well, I mean, maybe, yeah, they obviously want you to use it to save for retirement. I don't know. I'm sure there is. I don't know what that is, though. I get this question now, tax-free retirement accounts, which I've promised to look at, but I haven't had time, so I will look at that. Crazy man in the pink wig is back. Salty says you should never wear plaid on TV. It will bleed. Good thing to know. Of course, I've never been on TV. That's not true. I was on Good Morning. Was it Good Morning America? Yeah, they interviewed me. Oh, and I was on Good Morning Washington one time. Went down to the studio. It's interesting, like in the TV shows that I've seen, like the morning show, which I'm watching now, which I like. I don't know if they got great reviews. In any event, there's always all these people in the studio when they're filming. Maybe that's how it is on the morning shows. But when I was there was no one. There were the anchors. There were two of them. One came down to like a different part of the set to interview me, and that was basically it. All the cameras are remote control. No one else was there. It's kind of creepy. Dystopian situation. Anyway. Welcome, Index Investing with Cole. All right. Paul, I have 50,000 in each of my kids' savings. I want to put it in the market for 40 to 45 years. Will be worth a ton. Would you do 90-10, 80-20? What would you do? I would probably do 90-10. You could certainly justify 100. I guess you could justify 80-20. Wouldn't go lower than that. I'd do 90-10. I would just do a 3-fund portfolio. What I would do. But again, you could add something else, small cap value, emerging markets. That wouldn't be a mistake in my view. That's basically what I did for a long time. The more I invest, the more I think simplicity is better. And trying to guess which factor, which is what those really are, is going to pay off over the next 40 to 45 years. I don't know. Next question from D. You have convinced me to move 10% into bonds. Well, let me assure you, it wasn't my goal to convince you of anything. Should start to move 10% into cash first, then wait for a couple Fed increases. Well, see, now you're just trying to time the market. I get why. Makes sense. We know the Fed's going to raise rates. Of course, they're going to raise short-term rates, right? We don't know what it's going to do to like intermediate term. I mean, we can assume. But actually, some are saying the yield curve will invert. We could see a recession. We don't know. So, I mean, if I were doing it, I think, although I have some still in short term, I just haven't moved it over yet. There's no real reason. So, well, who am I to say one way or another? But I'm not, my decisions have nothing to do with the Fed. I can assure you of that. Every time I think I know where interest rates are going to go, I'm wrong. And then you got to know which interest rate are we talking about? 2-year, the 10-year, the 30? What is the 10-year? It was over 2%, right? Is it still over 2%? Yeah, opened it. Oh no, it's down now. It was over 2%, opened at 2.024. But man, it folded like a lawn chair. It's down to 1.965. So Kim says, Roth conversions make the most sense if the market takes a huge downturn, which I hope doesn't happen. We have no idea what taxes will be in the future. Well, yeah, I mean, I understand, right. I mean, the idea being, we think of conversions in terms of dollars, right? But you could think of them in terms of shares. I want to convert 100 shares of my S&P index fund. Well, what would that be in dollars? Well, it depends what it's trading at. And if it drops by 30%, well, it's trading a lot lower. Of course, yeah, and you could increase the amount of the conversion back up to whatever the dollar was, and you'd be converting more shares. The problem is predicting all of that, right? Quincy says, Rob, you had mentioned you own a small cap fund like VB, but your portfolios on your website, I'm trying to think, do I have my portfolio on my website? Own small cap value like VBR. So I actually own both. And the reason I own VB was twofold. I don't know that I actually own VB. I think I own the mutual fund version. So VB is sort of a blended small cap fund, and then VBR is, you can see them here. This is a blend fund, right? So we can go to portfolio, and it's small cap to mid cap, but in the middle. And then VBR is small cap value. So if we look at that portfolio, the blue dot moves to the left. Anyway, so historically it was small cap value for me. At one point I even know a Bridgeway microcap fund. I moved some to VB as part of a tax loss harvesting move, I want to say in 2018. And you say, well, why didn't you just move to like a different small cap value fund? And I think part of it too for me was this general migration to a more blended portfolio. Historically, small cap values outperformed everything. Whether it will do the same going forward, who knows? All right, Ryan, I am 23 years old, maxing out my Roth IRA. Congrats. And investing another 10K in my taxable account. No employer 401k. And you're doing great. When should I ideally hold my index target retirement funds? When should I ideally hold my indexed target retirement funds, considering bonds later on? I don't know that I understand that question. So Ryan, maybe you could try that one again. Sorry. So Justin wants to know about folks that say you can access your Roth conversion after 5 years as part of a Roth conversion laddering strategy for early retirement. And there, you're really using Roth conversions. You could get a tax advantage. So the theory is, and the mad scientist, I've shown you his website before. He's done a lot of work on this. You retire early, so your income drops, your tax brackets drop. So the Roth conversion should make sense, right? But you're also doing the conversions, not just because your taxes have gone down, your brackets, but because you need access to the money and you want to avoid the 10% penalty, but you've got that pesky 5-year rule that applies to conversion. So you'll convert, say, 1 year's worth of living expenses, say when you're 50. And in the meantime, living off, say, taxable accounts. And you'll do 1 year's worth of living expenses for 5 years running. And then for this, and then I guess at age 56 or whatever, you can then spend the first conversion you did. And at 57, you could spend the second conversion you did all the way up to 59 and a half or 60 or whatever, when you can take the money out of Roth or traditional, assuming again you've met all the other requirements. And that's a perfectly good strategy. It's never one I've followed. I just hasn't made sense for me. But I think it's a sound strategy for the right situation. Gage says, I'm tempted to transition from predominantly index fund investing to disciplined individual value stock investing in my Roth. Is that crazy? Well, I don't know. I'd have to know you better. I think for most people, it probably wouldn't work out as compared to just simple index fund investing. And I would put myself in that category. It's worked out for me largely. Well, it's worked out for me largely because of Apple and then because of the banks a year ago. And I've owned Berkshire for a while. It's probably underperformed. Let's take a look. I'm trying to remember when I bought it. But let's, here we go. Let's back test a portfolio. So it doesn't matter which one we pick, but I have B shares. Let's just compare it to SPY, which is S&P 500. This goes back to 97. Berkshire's going to certainly outperform then, but I didn't buy it in 97. I want to say I bought it in maybe 2013, be my best guess. I think I went to the 2014, actually, I think it might have been 12, because I think I went to the 2013 and 2014 meetings, I think. Yeah, so I've slightly underperformed if I've got the starting date. But the point is, I feel like I made smart decisions and they've worked out, but sometimes smart decisions don't work out. That's just the reality. Sometimes dumb decisions work out really well. You might win the lottery. So I'm not convinced that I know what I'm doing. It's the long and short of it. So are you crazy? Yeah, I think you've got a good chance of underperforming an index fund portfolio. And I say that simply because we all do. Wayne wants me to rank Schwab or Vanguard for retirement accounts. Well, the first question is, do you mean their funds or their platform? For funds, if I could only pick one and couldn't use the other, it would be Vanguard. I just think they have not better funds necessarily. Schwab has some good funds, but I would probably pick Vanguard for their index funds or ETFs if I had to pick one. I don't know, in terms of Schwab, do they have like a list of their index funds? Here we go. I mean, in some ways, it's kind of hard to pick because I'm sure they've got, particularly if we're talking about, retirement accounts. I don't have to worry about taxes. I'm just seeing if they have like a list. Did I miss it? Anyway, I mean, I probably would pick Vanguard without doing any analysis. I can't imagine Schwab's are better. They might be as good. In terms of actually where to keep my accounts, if I had to pick between the two, I'd absolutely pick Schwab in a heartbeat. I've really become, I'm a huge Vanguard supporter when it comes to their funds, not really when it comes to their platform. I don't know that I would say Schwab has the best, but certainly better than Vanguard. I don't like Vanguard's apps. I don't like their service. I've not had success with their service. Trying to get, in theory, depending on the assets you have there, you can get a financial plan for free. That's never, it sounds silly. It's like I've tried. It didn't work out for a variety of reasons. At one point, I moved a large chunk of our assets away from Vanguard, and I had the designated rep. Never heard from them. I don't even know if they noticed. In the 10 years or more that I've had someone assigned to my account, and that person's changed, and I get it. People come and go, and that's fine. I've never once called them and had them actually answer the phone. Not once. I love Vanguard funds. I love Vanguard and what it stands for, but it would not be high on my list of places to actually keep my Vanguard funds. That's my experience. Now, having said that, if you have a Roth IRA and it's at Vanguard, I wouldn't move it at all. Why move it? At various times I've had business accounts there, 401k, defined benefit plans. The website's terrible. It's worse than their main website. It's awful. But if you've got a Roth IRA or an IRA, taxable account, you may not need a lot of the things that say a Fidelity or Schwab offers. Where I think it becomes more an issue is when you start heading into retirement. But even then, Vanguard could work, right? I mean, but you asked me, I'm telling you. Okay, Ryan. Nope, I've answered that question. By the way, if you've joined late, remember to tag me in your comment if you want me to, respond to something. Yeah, Kim says, no one knows when they will become suddenly single when they use these married couple Roth conversion examples. It's absolutely true. Whether it's, because of a death or divorce, you make these projections. I mean, it's just one of the many uncertainties in the whole Roth conversion strategy. Ram says, how do you manage fulfilling your promises to viewers when you say I will do a podcast or I guess YouTube video on this later? Why not ask the viewers to rank from a list and give an estimate to time to fulfill? Well, for starters, I'm not sure how I would do that. It sounds like way too much work. And I do my best to get to videos that I say I'm going to do. I'm sure I'm not perfect. But yeah, it's an interesting comment though, Ram, because I've been trying to figure out, my channel is still a relatively small YouTube channel. I mean, I've got like 46,000 subscribers. I know YouTubers that have 500,000 or 1 million. And so I have no idea the level of email that they get, but it's already become clear that there is simply no way I can respond to email. It's hard to even read them now. I mean, read all of them. I'm trying, but it's overwhelming. And the list of topics that I have that I want to cover in the future is just, I mean, it's growing. It's hundreds. So I just do the best I can. And I still have to have time to do Turkish get-ups, which are really important. So I don't know. I guess people will tell me if they're unhappy with what I'm doing, but a lot of it comes down to how often I get asked about a topic. Some topics I can tell are just very, very, very narrow and specific, and most people might not have interest to them. But I'll tell you, I think reverse mortgages are important. I just have to do a lot of research. I think indexed annuities, I really want to do some content on indexed annuities, but they're immensely complicated. So Andrew, thanks for the compliment. So anyway, Ram, yeah, I hear you. I'm probably imperfect in keeping track of that. I do keep track of the topics though, in a Trello board. Gage says, while searching, waiting for value business investments, what is a good alternative to cash that I can liquidate immediately? Maybe a short-term bond ETF. I mean, you could, or just a cash reserves account. I mean, you're not going to make anything. I guess you could put your money in a high yield savings account. I think the highest is around 60 basis points. But you could put it in a short-term treasury. You have to recognize though that you can lose money, right? So Vanguard, we'll just use Vanguard. Their short-term treasury fund. Here it is. Oh, here we go. We look at performance. I'm sure it's lost money this year. Yeah, it's down 1.34%. So it was down 60 basis points in 21. So, you just have to recognize even a short-term ultra safe, treasury fund can lose money in the short term. Okay. Oops. Here we are. Russell says, I've been using Betterment and like their services, but looking down the road, it could end up costing more than $6,000 a year for their services. Seems expensive for what they offer. Thoughts? Well, yeah, I mean, it's 25 basis points. They have another service that I think is 40 where you can talk to an advisor. Although they also have an hourly option, as I recall, which could be a good deal. But yeah, it's 25 basis points. And once you're comfortable investing and managing it, this is what happens with advisors. And it's one of the reasons I believe that many advisors create really complex portfolios that are just unnecessary. Because if they're going to put you in a 3 or 4 or 5 fund portfolio, after a while, you look at it and you think, well, wait a minute, I can do this. And so you could get to the point, Russell, where you're comfortable doing it. And in which case, yeah, you'll save the 25 basis points. It's not trivial though. I mean, particularly if you're managing, a rollover for you, if you're married, a rollover for your spouse, Roths each, you got HSAs, taxable, maybe you're still working, you got a 401k. It's not trivial, but it's also not rocket science. And so it's just a question, is it worth it? I do think what you're doing, because you're translating that fee, that percentage into a dollar figure. And I think that's really important to do. I kind of wish there was a regulation that required advisors to basically send you a monthly or quarterly bill. This is how much we're taking out of your account. I think that would go a long way. And by the way, these are fee-only fiduciaries, right, that have your best interests at heart by law. But I got an email from someone who was using Rick Edelman's firm. His starting fee, it goes down as your assets go up. But I think this is up to 400 grand. I could be wrong, is 175 basis points. I mean, from a business perspective, I kind of get it because it's a smaller amount of money. So when you apply it, there's some if you're going to take on a client, there's some base sort of fixed costs that you have to deal with, record keeping, an advisor to work with this person, and so on. But boy, that's a lot of money. But I think you're asking the right questions. The question's going to come down to whether you're ready to do it yourself. And there again, that's why I think simplicity, the more simple, the better, by and large. So Kim says, if your traditional IRA gets too big and Roth conversions aren't a good idea, you can always donate. Yeah, we talked about that. The qualified donations. I think the cap is 100 grand. There's some limitations, and they can substitute for your required minimum distribution. Of course, you're going to, the donation would need to be part of your financial plan, right? I mean, right. Yeah, I suspect that once we get to require the RMD age, we'll stop using a donor advised fund and just give whatever donations we're going to give directly from the IRA. The downside is, as I mentioned, I'm pretty sure you can't contribute to a donor advised fund. And there's a one big advantage to contributing to a donor advised fund is that you get the tax break when you make the contribution, but you can let the money sit there and grow, and you can choose to give it then to the charities you want years down the road. And so, we do some tax planning, particularly because of the limitations on SALT deductions. We'll do a donation to the donor advised fund, say every other year, or maybe even every third year, and itemize that year. We don't itemize the other years, but we can still give money to the charities we support every single year out of the donor advised fund. So, there are some limitations, but Quincy says, as a Steeler fan, I wish Charles Woodson played for us. Yeah. Me too. Double Dog Blitz. I'm a saver by nature. Do you have some tips on spending money during the accumulation phase? I'm 48 and feel I'm behind in the amount saved. What? I don't understand that question. I'm a saver by nature. Do you have some tips on spending money during the accumulation phase? I'm 48 and feel I'm behind in the amount saved. Am I reading that correct, Double Dog Blitz? Do you mean some tips on saving money? You're going to have to clarify that one for me. I will say in terms of spending money, because my wife and I aren't big spenders, but one of the things I've really been trying to move towards is spending money in ways that make our lives just easier. Yeah. But I'm not sure that was your question. So, for example, I pay someone to cut our grass. We have someone help us clean the house every, once or twice a month. It's not outrageous, but it makes life a little easier. Okay, Sala. Thank you for your videos. You're from Chile. Nice. If I own, let's say, 33% of my net worth in real estate and 33% in bonds with a 5% yield, which would be a good asset allocation in stocks? Well, and you're 37. So you're already 33% in real estate, 33% in bonds, and I assume 33% in stocks, I guess. So is your question, should you sell some of your bonds to buy stocks? I mean, generally, all other things being equal, someone who's 37 and they're not going to retire till they're 65, which may or may not be your situation, I would not, if I were 37, let me answer the question that way. If I were 37, I would not have a third of my assets in bonds. I would have 10%. I also wouldn't have a third of my assets in real estate, but you could be an investor directly into real estate, and if so, that's great. That's a good way to go. I would probably create my asset allocation plan outside of the real estate, but it might still influence my asset allocation. So, for example, let's just use $1 million because it's a nice round fat number. If I've got 330 grand in real estate, I might, for my asset allocation, say, okay, one, I'm not going to put any in REITs, maybe. For my real estate, it was residential So one could still argue that REITs might make sense, but whatever. But what I might do is say, okay, for the rest of it, I'm going to actually have a somewhat more conservative portfolio because I've got a third in real estate. I don't know what that would look like. 80-20, 70-30, depends. But still 37 is pretty young, so I still might be 90-10. I don't know, maybe 80-20, again, because of the real estate. But I certainly, again, speaking for myself, I would not be a third in bonds at 37. But there could be some circumstances where that makes sense. And I don't know your retirement plans, how much debt you have, your income, how much you need to retire. I mean, there's countless issues, factors that you'd want to think about. So I get this question every now and again. And it's from Dave. He says, what is the most advantageous method to determine the profit or loss for tax reporting in a taxable account? Average cost, first in, first out, last in, first out. And I think it's going to, I don't think there's a single answer to that, Dave. I think it's going to depend. I can tell you I've always used average cost. It's just simple. I'm not an active trader, so I don't have like tons and tons of purchases of stock. I mean, even Apple that I've owned since 2013, and I had a few small purchases when I was reinvesting the dividends, but they're insignificant. My actual purchases are just 3 of them. Now, and I'm donating the stock to charity a little bit at a time. I suppose if I actually wanted to sell it, I might want to choose a specific lot in that circumstance. But that's unusual, I think, would have a purchase in 2013 and then not another one again for 5 years. And then I had another one the next year. But like with funds and whatnot, I've always just used average cost. And that may or may not be it probably is for me. Probably wouldn't make a difference, as I said, because I'm not an active trader. If you're an active trader or more active than I am, it could very well make a big difference. But I think it's going to depend on the circumstances. I don't think there's one answer. That one approach is always the best. Justin says, my accountant advised me to recharacterize my Roth into a traditional to lower my tax burden. It's currently 100% S&P 500. Should I change the allocation since it's no longer a Roth? So I don't think you can recharacterize anymore, right? Pretty sure that's true. So maybe this was something you did when, when could you recharacterize Roth IRA conversion? I don't think you can do that anymore, right? Maybe you can. I don't think you could. Maybe you can. I don't know. In any event, it's not really your question. Your question is, now that you're in a traditional, should you still be in S&P 500? Well, again, I do asset allocation across all of our accounts. The bond portion I like to put in traditional retirement accounts because I want stock allocation that I expect to grow the most over long periods of time to be in Roths. And to the extent I have some that need to go in a taxable account, that's okay. They're pretty darn tax efficient. And so that's my approach. And then the other nice thing about having bonds in a traditional is that their expected returns are lower. So it'll help me out on the RMDs, a couple of decades from now. That's my thinking. Mary, do you have any thoughts on Delaware statutory trusts? I have no thoughts on Delaware statutory trusts. I don't even know what one is. Here we go. So I guess they're used with real estate. Mainly commercial, it says. Yeah, but I don't know. I don't have an opinion on that. Sorry. So Coke, I don't know how to pronounce the name. Do you think it's a good time to buy a house, or do you think housing prices might collapse soon? I have no idea. I really don't. I mean, they've obviously been on a tear. We expect, seems like interest rates are going up. I know mortgage rates have gone up. You can look at them. Obviously, all other things being equal, as rates go up, values are going to go down. That's true of assets generally. So, here's Google. You can see the rates up to 4.4% according to Google. We can probably do better than that. But so I think the housing prices could very well go down at some point in the not too distant future. But I probably personally wouldn't make my decision based on that prediction, just because I've proven not to be good at predicting future interest rates. I suppose if I weren't in a particular hurry to buy a home and I was comfortable waiting a couple of years, I probably would. Not because of a prediction on interest rates per se, but I do suspect values will moderate, although, doesn't mean they're going to go down, right? It could just mean that their increase slows. But I mean, the other aspect of it is, I would try to avoid like bidding wars. So if you live in an area where, every house has 15 contracts or something ridiculous, and you got to pay cash and you got to waive the inspection and you got to have a escalation clause, so you pay more than asking. I personally, unless I had to have a home, I would not want to buy in that market. I'd love to sell in that market, which we did. When we bought our home, it was in 2019, and we had multiple offers on our home, and it sold for above listing. The house we bought, as I recall, at the list price. So Scott wants to know if I've ever used Finviz. I guess I can show it to you. I have not. In fact, maybe you mentioned this to me. I just saw it really for the first time. Here it is. It's a website, finviz.com. They've got news. You can see the heat map. Shows you what's going on. Is this today? It's kind of cool to play with, but I've not really used this. What's the market doing today? Oh yeah, it's down. All right. Microsoft is off 176. Yeah, so this is today. I mean, maybe there's some time delay. Boy, lots of red. Anyway, but yeah, it was kind of fun to look at, I guess. But I don't do much with this. Yeah. Sheldon says, hey, Rob, I've been a subscriber from early on. By the way, you can subscribe to the newsletter. Link will be below or is below the video. Goes out every Sunday. I enjoy putting that together. Anyway, really appreciate, he probably was referring to being a subscriber of the YouTube channel. So I'm trying to get to 100,000. So I get this fancy plaque from YouTube, and then you guys can vote as to whether or not I replace my wife's wedding picture that's right behind the Kleenex with my new plaque from YouTube. But how many subscribers do I have? 46,026. It's going up about 5,000 a month. So I'm on track to hit 100,000 by the end of the year. Remember, subscribe early, subscribe often. Anyway, you've mentioned that you're a gamer. It would be more like gamer. Could you let us know what gaming system you use? Sure. So I bought a, what's it called? Hang on. Oh yeah. I bought mine from iBuyPower, and I bought it. I don't know how bad it is now, but like nothing was available. At one point I wanted to build my own system, but it's got a Threadripper. It's an AMD processor. I think it's 32 core. It's ridiculous. And I got I think it's a 3080. I think it's a 3080 video card, and I don't remember how much RAM I got, but it's a lot. And it's got a cool case, that lights up, and it's what I would show it to you, but it's what I use to power this stream. And it crushes the iMac that I have. The iMac is what I show you when I show you something on the screen, and I'm probably going to replace it at some point here, maybe with a Mac Pro, but I haven't decided. But yeah, I love the system. It's not cheap. Trying to remember how much it costs, but so far it's worked out great, and it's lightning fast. I actually use it for analyzing chess positions, which just uses a lot of the processor. It depends on the engine, a lot of the processor and or a lot of the video card. I was playing Call of Duty. I was going to play online, with my son, and he said I needed to get a little better before it made sense for he and I to play, and that hurt. I'm not going to lie, that left a mark. No, I don't think I could keep up with him and his friends. It would be silly. I'm the guy playing who still hasn't quite figured out the controls. So I'm trying to look. Even now, I'm showing you like a controller, but no one uses a controller anymore. I've got my keyboard, and I'm like, wait a minute, how do I crouch again? What do I hit? What's the space bar do? And then I'm dead. See, that's how it works for me. Oh, okay. Jeff says, when you say trigger taxes in retirement, is that just an abbreviated term for keeping taxes low such that you avoid having any income in the higher federal bracket? I'm trying to remember the context. I'm not sure what the context was. Maybe it had to do with RMDs because, once you get to 72, that's going to trigger taxes. You're forced to take money out of a traditional retirement account. You're not forced to spend it, by the way. You could just leave, it comes out and goes into a taxable account. It could be a checking account if that's where you ask your broker to send it. Could be just in some sort of cash reserve account at your broker, but it goes into a taxable account. You can do whatever you want with it. You don't have to spend it. I'm guessing that's what I meant, though. Jeff, although I just can't quite recall what I was saying when I used the word trigger. Mike says, and this is the pink wig guy, do you think China will ever become a developed market, therefore changing how emerging market funds and developed market funds are allocated? That's an interesting question. I assume they will. That does, when an index has to make that change, though, and how they would make that change, I don't know. That would be interesting. But don't you think so? I mean, how long can a country, and now I'm referring to the United States, with, what do we have, 350 million? What's the population? Population of the USA. 330 million. That was 2020. I mean, how long can we dominate? I mean, our GDP is isn't it like 20 trillion? And I think China's next at 14. I mean, how long can that continue? GDP by country. United States, 20 trillion, 19.5. China, 12.2. I don't know if this is, here's what I'm looking at, by the way. Oh, this is 2017, so it's maybe changed a bit. And look at it per capita. This is an interesting one for China. Of course, they got a lot of capita. A lot of people. What do they say? Like if you're one in a million, there's like 1,000 people just like you in China. Yeah, that's not quite the numbers, but you get the idea. So I mean, how long can that continue? I don't know. All right, Connor. Good morning. I've enjoyed making these shows a part of my week. My question is regarding stock bond allocation. I'm 19 and I'm 100% stocks. Why shouldn't I keep it like that until I retire? Well, I think at 19, it's perfectly reasonable to be at 100% stocks. I don't recall that being my choice. Although it might have been at some point really early on. I mean, the truth is, I started investing in 92, 93. I don't remember how I invested. Like I couldn't tell you my stock allocation for most of the 90s, or if I was even thinking that way at that point, because I didn't know anything when I started investing. But you certainly can make the argument that 100% stocks is totally reasonable. I'm not sure I would keep it there until the day you retire. I probably wouldn't keep it there, even if that's what I thought was my plan, until the day before I needed to start spending it. I would start to go more conservative to whatever my retirement allocation was going to be, probably at least 5 years before retirement, and maybe more. That would be my plan. But I can't argue with someone who's 19 and wants 100% stock. Just, buckle up. That's all. You're in for a ride. You'll lose 50% of your portfolio or more. Probably between now and when you're 30, be my guess. So as long as you're okay with that, as long as you can live through that, not bail and sell, right? That'd be my guess. You're 19, yeah, in 11 years. Should we have a 50% market correction? Or would they call that a correction? That's a heck of a correction. By the way, at 19, you should hope that happens, because you'll be just buying as you dollar cost average, 401k, IRAs, whatever. You'll be buying cheaper and cheaper. It's exactly what you want. So Jeff asked the question, I don't know that I have the answer. He says, does Portfolio Visualizer express a measure for upside or downside participation? I suppose this is akin to beta, but wondering if there is a more specific measure. I don't know, Jeff. But if you go to Portfolio Visualizer, you might be able to find what you're specifically looking for. They have a lot of, I tend to show you a back-tested asset allocation or portfolio. They have a lot of factor analysis. Here's fund performance, which may or may not get you what you're looking for. As you can see, timing models. So there's a lot of different, I haven't even, like financial goals. I haven't even looked at that tab. I have no idea what this is, so there's a lot going on in this tool. But I don't know specifically to your question. If you find out, will you let us know? Yes, Vinyl's reminding folks, if you have a question, tag me, because I skip over the tags. For me, appear in orange. So if there ain't orange in the comment, I just assume you guys are chatting back and forth, saying just, how incredible this show is, or words to that effect. Keith, I am 24. I have about $35,000 in the S&P, $20,000 in UNH stock. United Health? I assume that's what it is. What's UNH? UNH. United Health. All right. Through an ESPP, employee stock purchase plan. And about a combined $45K in a Roth IRA, 401k, and traditional. Should I hold all? You had me up until the question. I guess you're asking me, should you make changes to this? But first of all, I don't know what the 45K that's in a Roth IRA, a 401k, and a traditional spread over some amount. I don't know what they're invested in. You've got 35,000 in an S&P 500. That in and of itself is, obviously an asset class that is a big part of most portfolios and a good one, right? So it's hard for me to answer your question. I will say that given the amount of money you have, which is 90,000, if I've done my math, 70, 80, no, 100. You've got 100,000. 20% is in UNH stock, which is also where you work. Now, I don't know that I'd be too concerned about a company like United Health Group going out of business, but I guess anything's possible. But that's a lot of single stock exposure. I'm not suggesting you should go and sell it, but I do think it's something that you should consider whether you're, that single stock exposure is right for you. It's a question. Mr. Wonderful, I heard him, Kevin O'Leary, right? Shark Tank, that guy. I heard him say that he never has a single stock that represents more than 5% of his portfolio. That's sort of his rule of thumb that he lives by. I don't personally live by that rule, but I don't think it's a bad one. I mean, I understand why one would use such a rule. You don't want too many eggs in one basket. So that's the idea. And I don't really have a defined limit where if my Apple stock goes above this number, I'm selling. Maybe I should. but I don't. I look at other factors too. I mean, depending on your situation, if you go to retirement, you may need every dime you've got. And so having single stock exposure could be a big deal. On the other hand, maybe you don't need every dime you've got and you never will. So I think every circumstance can be different. And so what could be right for one person might not be right for another. So Keith, I don't have an answer for you as to whether having 20% in the stock of the company where you work is a good or bad idea, but it stands out to me as at least something you need to really think about. But for the rest, I don't know what's in your Roth and your traditional and all that. The 35K in the S&P 500, I don't even know what percentage of all of your assets are stocks versus bonds. But those would be things that I'd be looking at. So Aaron says, all I need for the growth of my wealth for the next 16 years. Now, I don't know why 16. I don't know what happens in year 17, but that's what he's focused on. Fair enough. I'm thinking 90% in either VUG or QQQM. So think of these as U.S. large cap growth funds, right? And the remaining 10% in TQQQ. That's the leveraged QQQ, right? Yeah, Pro Shares, Ultra Pro, QQQ. So you're basically all in on growth and tech. I don't want any dividends at all. Well, you're going to get some, I think. I mean, VUG has some dividends, right? So does QQQ. Oh, you have QQQM. But it still has some dividends. It's got to. Yeah, not much. 44 basis points was its dividend yield over the last 12 months. Here it is, right there. And VUG has dividends, right? Again, small, I'm sure. 53. So, but to me, yeah, I don't know exactly what your question is, but I personally think that is a very risky portfolio, particularly given the prices right now and the interest rates. I mean, here's the reality. Prices in the growth sector of the market are driven in significant part by low rates. So if interest rates go up, the growth sector will get hammered. Now, I suppose maybe they don't go up. Maybe they stay low. They go up for a little bit. We're fighting inflation. The Fed does its job. And they go back down to 1-2% a year. But that would scare me. Here's a good question from Jerry. Any cost fee difference if I keep VTI, which is Vanguard's total stock market index fund, ETF, in M1 versus Fidelity or Vanguard? Not that I know of. There should be no fees for either of those, for the three of them. You can by and large buy ETFs just about anywhere transaction free. And most places don't have an account fee. So I don't believe there's a fee involved. Now, of course, VTI has an underlying fee. What is it, 3 basis points? Or that's not what you're asking about. But let's look it up. Yeah, 3 basis points, 3 bips. Salo wants to know, is Citigroup undervalued? I used to own Citigroup a long time ago. It's just, is it C? Yeah. So one of the things that I try to figure out is based on the industry a company is in, what are the metrics that are the most important, right? And so one of them is price to book. And so what this means right here, this 0.73, is that it's valued below book value per share, right? And as a general rule, that indicates potentially a really good stock for banks. Of course, sometimes they're priced inexpensively for a reason, right? At the end of the day, for me, the issue with Citibank, and this is not recent, but I felt that it was such a complicated financial institution that it was really hard for me to wrap my arms around the bank. Because, you think about a bank and you think, well, it makes money because it takes in, deposits and other sources of funding at one rate, and it lends out at a higher rate, hopefully, right? And it makes the difference. And so, in fact, another metric for a bank is net interest income. Let's see. I'll see if I can pull it up for Citibank. Don't know if I can. Let's see. I mean, I can. I don't know if I can quickly. Anyway, I don't need to pull it up. You understand the concept behind it. It'll be in their 10K. I could find it somewhere. Net interest margin. Here it is on Guru Focus as of an ad. As of September 21 was 2.5%. So one of the things you want to look at is its trend, and also comparing it to other banks, right? So in just the abstract, it won't mean much, but how's it trending? How does it compare to competitors? One of the things that you also look at a bank are expenses, because at one level, banking is a commodity. A savings account's a savings account, and they try to distinguish themselves with fancy apps and branches, right? Still, even in today, marketing. But at the end of the day, a lot of it's almost a commodity based. So how much they can control expenses is a huge factor. In the case of Citibank, though, and other banks, there's a lot of other ways they make money. Trading floor, Chase, for example, through their investment arm, makes a lot of money. And of course, their lending is not just like you think of like personal loan or car loan. They could have, a credit card portfolio, and that has a whole different risk profile, right? Depending on the kinds of credit cards. So having blathered on about all of that, if I were looking at banks today, Citibank would be on my list of one to consider. But and I haven't looked at it in a while, but I know I found back in the day it was really complicated bank to understand. It's got a lot of international exposure, which can be a good thing, can be a bad thing, but that complicates for me the analysis. I try to keep things simple, but it would certainly be on a list of companies to look at if I were looking to buy something today. Yeah. I wonder if I'm curious if any of the value investors that we see here are buying Citibank. Not that would be a reason to buy it. Oh, it's not in the top lists. I'm looking over here. Again, that wouldn't be a reason to buy it. What? Huh, interesting. Not so far. Here we go. Small percentages, though. Ownership count 10. In any event, I don't know how helpful that was. Mitch, do you believe, like Mr. Dent, isn't he from a Spider-Man show? Anyway, don't know who that is. That the stock market is going to crash like 90% in the next 10 months? No, I don't. And I also don't believe that it's not going to crash by 90% in the next 10 months. I mean, all of the predictions about what the stock market will do in the short term, I think, are utterly ridiculous. No one knows. There's someone predicting something all the time. And they don't care about timing. Like, they'll come out and say they were right because they predicted a market crash for a full year before it actually crashed. That's not a prediction. That's silly. I mean, crashes happen regularly. So we can all sit here and predict them, and eventually we'll be right. 90%, I mean, something would have to happen that we can't possibly foresee. 90%, that's not a correction. That's like, that's 1929 to 31 kind of price action. So anything's possible, but no one can predict that. It's silly to think. Anyone who thinks they can predict it, it tells you more about them than the prediction does about the actual stock market. Okay, there you go. All right. Whoops. What else we got here? How are we doing on time? 12:30. All right. Whoops. Did I see a kettlebell question? Salty's really got a thing against kettlebells. Oscar wants to know if I think it's a good idea to scoop up FTEC now. I'm holding this for the long haul. I hold everything for the long haul. Except for the kettlebell. That I don't hold for long. Okay. Fidelity MSCI Information Tech. Well, this is one of those it looks like one of those sector-specific funds. I want to look at the sectors. Yeah, it's a tech. So I generally don't tilt my portfolio towards a specific sector, at least not the index fund portion of my portfolio. I'm curious. So it's inexpensive, 8.4 bips, right? So this could be a perfectly reasonable tech fund. It's going to have a lot of ups and downs. Again, I worry a bit about the growth sector of the market because, so here's something to keep in mind. There's always the narrative behind why something happens in the stock market. So, this is growth, technology. And so what's the narrative? Well, particularly with COVID, we're relying more and more on tech. Tech is the future. It helps us communicate, work remotely. That's, we may end up going back to the office some, but remote work is certainly here to stay. You could get into the electric car area and say, that's the future, and autonomous driving and all the tech, it's all the future. And that can all be true. We could assume that's all correct. It probably is, as far as I know. And it still might not explain why growth and tech funds have done so well. It may describe some of the reason, but if that's the problem. If we start to buy into the narrative too much in terms of explaining why PEs are what they are, valuations are what they are, because if we think that narrative really explains it, then why would we do anything but put money in growth and tech? Because that narrative, and I believe it's probably largely true, I don't think it's going to end tomorrow. The problem is, what if that narrative, as true as it might be, is not the complete explanation for why some of these funds have done so well over the last, year or two, but certainly 10 years. What if there are other reasons? And those other reasons may not last, like interest rates and low inflation. So if that's part of the explanation, and I think it is for crypto as well, then we've got to factor that into our thinking. So while the future of technology, maybe we've got it right, but we could still see some significant losses if we don't factor in the other things that have affected the price, which in my mind are interest rates and inflation. So, this may be a perfectly good tech fund. That would be my concern investing in it today. And what's its performance? It's got to be down this year, right? I think. Yeah, it's down 9%. I mean, that wouldn't be a reason to buy it or not to buy it. But you don't have years like this in perpetuity. Yeah, wish you did. Well, actually, I don't wish we did, because if you had those years in perpetuity, then we just have to be outperforming that higher mark. It would never end. Steve wants me to talk about indexed annuities. Well, I can talk about them generally, and here's they're sold as a way to address our fear, particularly in retirement, and of losing money in the stock market. That's sort of the big fear. And so the idea is And they vary because they're based on the contract with the insurance company. But the idea is they're sold. They'll say, look, you're going to earn some income that's based on an index. You're not invested in that index, but you'll earn a return based on that index. I know a lot of them are point to point, so they disregard the dividends. What was the price of the S&P 500 at the start of the year? What's the price at the end of the year? And let's assume it was up. Great. That's what you would earn. But well, with the caveat, hang on for a sec. The problem, and what they'll say is you'll never lose money. So if the S&P, it doesn't have to be the S&P, they could look at another index, but we'll use the S&P 500. If it goes down, it's negative for the year, you won't lose money. You won't earn any money that year, but you'll stay where you were. So that's the upside. That's the benefit, right? But what they'll say is if the market is up, you'll earn a portion of that increase. And it can be defined in a couple of ways. You could say, well, you'll earn the upside, but it's capped. So you'll earn the upside, but it's capped at 5%. So anything above 5%, you don't get, or 10%, or whatever the cap is. Or maybe there's no cap, but there's a participation rate. So you earn 70% of the upside. So, and there are other issues, but for a lot of people, that sounds pretty good. No downside. Yeah, my upside's limited, but no downside. That's really what we're afraid of, the downside. And the problem, though, is that that's a very expensive insurance policy, and it's not transparent. It's transparent in how it works, but not transparent in the outcome. So, for example, let's say you were going to buy a $100,000 indexed annuity. One way to do it is to say this: here's what we're going to do. If it goes below zero, you don't lose anything. If it goes up, you get all of it. Whatever the upside is, point to point, you get it all, and it costs you $5,000 a year. Wow, I'm just making the number up, but now we can see it, big fat letters, $5,000. Here's what I'm investing. This insurance policy is costing me, so I will never lose money, but it costs me something. Here's what it cost me, some big, fat, hairy number. Now we can make a choice. Boy, yes, no, whatever. But when it's not couched that way, it's participation rate, it's caps, it's fees to take your money out early, it's fees to have this rider and that rider, and inflation protection, whatever. It's hard to actually see just what the impact of those fees could be. And so I think for most people, indexed annuities are a bad idea. That's my opinion. I could be wrong. But like I sometimes say, in the words of the theme song to Monk, I don't think so. It's a jungle out there. All right. I love it when I've seen some salespeople, even on YouTube, will say, you'll never lose money. You'll never lose money. We've got this hypothetical. Look how your money grows. And I'll ask them, yes, but is there a participation? No participation rate. You get it all. Well, up to a cap. And the cap, or the other way around, there's no cap. But they don't scream the downsides, right? It's kind of like a boss of mine, before I went to law school, I was doing some contracting. He goes, remember, Rob, in a contract, the big words giveth and the small words taketh away. Yeah. So Ron asks, what is your opinion of using dividend-paying stocks as a temporary substitute of bonds in a retirement portfolio? I don't think it's a good idea. Bonds do a couple of things. One, earns some yield. I get that it's low, but they also stabilize the fund, the portfolio, from losses. Dividend stocks don't. I know one could argue, depending on the sector and the stock, they are somewhat less volatile than some other stock, but they are still volatile, much more volatile than, say, a treasury bond, at least short to intermediate term. So I really don't think it's a substitute. You're adding more risk to your portfolio. By risk, I mean volatility. Now, that may be a perfectly reasonable thing to do, depending on the circumstances, but I just don't view dividend-paying stocks as an alternative to bonds. They're different than bonds. At least if we're talking, again, high credit quality, short to intermediate term bonds. Yeah. It's interesting to look at AT&T, big dividend, but they're losing money. In fact, in the newsletter I sent out, I think it was maybe last week or this week, there was an article. Where did I get that from? Was it a Wealth of Common Sense? I don't remember. It's a great article that talked about AT&T and comparing its dividend yield with its price. Here we go. This is it. I found it. It is. This is why you should join the newsletter. This is a great article. Let me get rid of the ads. What is this? What am I looking at? Okay, he's looking at slides. I don't want to see slides. Oh, now we've got a pop-up. All right. We're getting there. Higher yield makes for safer investment. So here we go. Here's the history of the AT&T dividend yield, going back to what, 01? Up and down, it's at 8.6%. Average is 521. Not bad, right? Here's the price chart. Oops, that doesn't look pretty. What the yield giveth, the price taketh away. And then total return versus the Vanguard Total Bond Market Index Fund. Yeah, it's pretty shocking. Anyway, it's a good article. Index investing with Cole wants to know how he or she can be as smart as I am. I don't know. I mean, you certainly, I think you should aim for the stars, but keep your feet on the ground. I don't know. Not going to be easy, particularly when I'm the only one that can talk on this show. See, that's what helps me. If you guys could question me live, the wheels would probably come off. All right. We got 15 more minutes. Todd, any thoughts on HSA for retirement? Which Medicare premiums can be paid from? Yeah. I love HSAs for retirement. I just did an HSA video, so you can check it out. Yeah, that's how we're using ours. Plan to. We're just investing it now, not spending it. Probably, I suspect we'll start using them for Medicare premiums. You can't use them for the supplemental, the Medigap, I don't think, but. All right. Quincy wants to know if I would live in an HOA community. I never have. I'd prefer not to, but I can't. Yeah, would I? Sure. Why not? I mean, I know they can be expensive. The HOA fees here in Northern Virginia for condos are astronomical. $400, $500, $600 a month. It's ridiculous. Gus wants to know what assets are more suitable for taxable and tax advantaged accounts. Maybe a video you can do. Also, what is a good fund for a Roth account to get as thick as a tick? It's fat as a tick. Maybe thick as a tick is better, but anyway, so as a general rule, I like stocks in Roth accounts. So, if I've got even just a simple 3-fund portfolio, I'm going to put maybe S&P 500 or total stock market index funds in the Roth. Any bonds that I have, I'm typically going to put them in a traditional retirement account. If I'm going to invest in REITs, I'll have it in one of the two, not in a taxable account. In the taxable account, I tend to have, some stock index funds. My situation is a little different because our taxable account's about 2/3 of our total. But stock index funds, if I'm going to have bonds, typically it's municipal bond funds. I have stock index funds in the HSAs, again, relatively small amount. That's how I think about it. Rich says, super helpful show. Thanks. You're welcome. I don't think you asked me a question though, Rich. Happy to discuss a topic. I think Double Dog clarified his question. Enjoy saving and investing more than spending. Do you have some tips on how to balance this situation? Yeah. Well, on the one hand, I don't want to spend just because I feel like I should or because I have the money to spend. Of course, all of this is relative. I don't know. Maybe you're debating on a 70-foot yacht. But I have, my wife and I have talked about this. I do want to spend in ways that make our lives easier. So we do that. And again, it could be help around the house. How we travel. We travel in a slightly upgraded. We tend to travel in business class if we can, because it just makes life a little easier. We don't travel a lot now, so that's not much of an issue. But that to me is the big thing in terms of like buying stuff. I don't really have a lot of stuff that I want to buy. And the things that I do buy are relatively inexpensive. It might be, another kettlebell. I need to buy one for Salty and mail it to him. I don't know where he lives. So we're not talking about a lot of money. But yeah, to me, it's buying things to make life a little more convenient is the big thing for me. Keith, he asked me the question about having the United Health stock. And he mentioned in his, I guess, Roth and 401k and tradition, he's got VU, VX, AIX, and VYM. I mean, those are all good funds. VU is S&P 500. And isn't FXAIX, I thought was an S&P. Yeah, it's also an S&P 500. My guess is you have two different funds because one's in the 401k, probably the FXAIX. That makes sense. And then you have a high dividend yield. So, no international. I personally like international, but I like those funds. I've got no argument with those funds. High dividend yield is going to be more of a value fund, I assume. Which I personally, if I were going to tilt in the large cap one way or another, I personally would tilt value. Doesn't mean I'm right. In fact, I'd be wrong the last 10 years, but that's what I do. So what else we got? Mitch says, subscribed, liked, and shared. Thank you. I wonder if that's Mitch, my good friend, or if it's Mitch, and I don't know who it is. Jacob wants to know, what does gaming have to do with Roth conversions? No, nothing. To make that clear. It has a lot to do with a lot of things, but not Roth conversions. Here's a good question. Is it possible to max both a Roth 401k and a Roth IRA, assuming you qualify and income limits and whatnot? And absolutely, sure. You can max a 401k, whatever kind it is, and you can max an IRA, again, assuming you qualify and whatnot, regardless of what kind it is. And it doesn't have to be the same. You have a Roth 401k and a traditional IRA, or you can mix it, right? You can't go over the total limits, but you could contribute to both a Roth and traditional IRA if you wanted to. You got to combine the contributions. You get one contribution limit. You can't open up 37 IRAs and contribute 6,000 to each during the year. That's not allowed. But yeah. All right. So Carr asks, what would be considered a high turnover rate for an actively managed fund? Well, it's a good question. The way I think about it first is like, what does an index fund turnover look like? And it's going to be under 10% for most of them. We're talking about stock funds, by the way. Let's look at the high dividend yield. It's an ETF. I think the turnover is on the portfolio page, but I could be wrong. Yeah, so it's 8%, right? If we look at VU, I'm going to guess it's lower. But I could be wrong. 4%, right? But if we go to an actively managed fund like ARC, this is going to be higher. I think we've looked at it before. I think it's 70%, but Yeah, 71%. So the turnover has, well, two primary issues. One, doesn't have to, but it can generate capital gains. Not an issue if it's in a retirement account, but if it's in a taxable account, it could be a big issue. The second issue is they pay transaction fees to do all this buying and selling, and transaction fees are not accounted for in the expense ratio. So it can increase the costs of the fund to you. So those are sort of the two concerns. The third one might be more of a philosophical concern, and that is, if it's a high turnover, why? Why are they moving in and out of positions? And is that the kind of investing, that you want to buy into, which would only be relevant in an actively managed fund? But so it's hard to say that at this turnover ratio you should be concerned. I would say more, you need to consider these things if you're going to invest in an actively managed fund. And there, it's not so much the turnover rate per se, but capital gains if you're in a taxable account, fees generally. I mean, I would probably, on a fee basis, you can look at their statement of additional information is where you get that number. And maybe these funds are so large that that's still a relatively small part of the fee structure. I don't know. Beyond that, in an actively managed fund, if I were interviewing the fund manager and their turnover was anything above, let's say 20%, I'd probably, why? Why are you getting in and out of, a fifth or more of your portfolio each and every year? Be a question. Of course, I'm probably not going to get a chance to interview Kathy Wood. Malay says, I know you can do Roth conversion in kind. Can IRA distribution can be done in kind to a taxable brokerage? Okay, so first of all, thinking about a Roth conversion that's in kind really is only relevant in a taxable account. If you're doing a Roth conversion and you're converting pre-tax money to a Roth IRA, it's taxable. Whether you can do it in kind, whether they'll allow you to transfer the assets just so you don't have to buy them again, think of that as more of a convenience. When you're taking pre-tax money out of an IRA, putting it into a Roth, it gets taxed, right? So in kind is more like you have a taxable account at broker A and you want to move it to broker B without triggering the unrealized gains. Here we go, triggering. See, I use the word trigger. Without triggering taxes, you can move it in kind. But in a retirement account, it doesn't make sense. It's not relevant. And can an IRA distribution, can it be done in kind to a taxable brokerage? Again, I don't know if in theory they can do that or if it has to go to cash first, but it's not going to prevent the taxes, right? I hope that helps. Oscar, what do you use to switch to screen share so quickly? I'll show you on the screen. I was going to pick it up and show you, but then I realized I could unplug something. It is a Roland VR 1 HD streaming mixer. And I've misspelled it, but maybe it'll show up anyway. Really? Amazon? I misspelled it and you can't figure that out? There it is. And right now you can get it at a great deal. So its list price is $1,400. They're selling it for $600. I think I paid $1,000. It's this thing right here. And so you see it's got these three buttons right there, 1, 2, and 3. So if I push button 1, you see me. If I push button 3, you see the screen. I'm not using input 2 at the moment, but when I show you my iPad, it's input 2. Yeah, it's pretty good. This is a great question from Shooter. Looks like he's a gamer. Do you think Vanguard will lower the expense ratio for life strategy fund like target date funds? And if so, will they repeat the fiasco of the unexpected capital gains? I don't know. I don't know that I would trust my money in a taxable account. I don't know. One of the things I can tell you is that it wasn't just lowering their fees, it was lowering their fees to their institutional investors. So, and I looked at this back at the time I did the video, institutional shares of Vanguard Life Strategy. I do think they have an institutional share class, but maybe they don't. Yes, they do. And it wasn't, they didn't actually lower their fees. They lowered to their institutional share class. They lowered the minimum investment required. I think from 100 million to 5 million. Here's VASGX is an institutional level life strategy growth fund. What do they say? Fees and costs. So they don't have any info here. It's 12 basis points. So I don't know, but I think it's I don't know, but I think it's an important question. So allocator 3844 says, I watch your videos from England and find them very useful. What do you think about the FTSE? That's FTSE. Well, that's FTSA 100. I wonder if you meant FTSE, probably. FTSE 100 and its recent performance. I don't know what its recent performance has been. Let's find out. Here we are. So today it's down. That's probably not what you meant. Well, 6 months it's up. Year to date, it's flattish. Well, this says year to date, oh, plus 32. I see, 43 basis points. So it's been kind of flat. But I honestly don't follow the FTSE 100. 1 year it's up significantly, 13. Well, I say significantly, 14% right here. But I don't know. I don't really have an opinion about the FTSE 100. All right. So Mike asked a good question. Why have you chosen not to add small international stock? Just to keep my portfolio simple. I mean, I do have, well, it's a good question. Because the fund I use for international doesn't actually have small cap. I wasn't in VXUS, the mutual fund version, and switched to a different fund. Again, I think this was in 2018 for some tax loss harvesting, and the fund I went into did not have small cap. I would personally use a fund like VXUS, all other things being equal, and if there were no tax issues for me. And it includes, not a ton of small cap, but we can look at it. Here it is, and I'm pretty sure it has small cap. So the way you figure that out, you go to portfolio, you come here, and this doesn't tell you much, but then you go to weight. Yeah, it doesn't have a ton of small cap, but 4%, some mid cap. And that's what I would do, all other things being equal. And so I might end up buying some small cap international at some point, because I do think it's good exposure to have. But, again, all of this is relative, and of all of the things I need to worry about, it's not the thing that keeps me up at night. Actually, lately, nothing keeps me up at night. I sleep like a baby. Norma says, best place to keep cash in retirement. She uses Vanguard. I guess it depends on the purpose. Is it your spending account? You're going to spend it, or are you wanting some part of your portfolio to be allocated to cash? And then it depends on how much cash we're talking about. If it's certainly below the FDIC limits, probably an online savings bank account would give you probably the best yield that you can get without risk of losing money. If it was beyond that, well, there's other ways to get more than 250,000 in FDIC insured accounts. So you could probably always do that in some way. But, if you're going to be using it soon, just a money market, probably what I would use. So let's see. it is time to end the show. It's gone by quick. I know I haven't gotten to all the questions, and I'm sorry. I never do. So, a couple announcements. I won't be doing the Monday night stream because I'll be coming back from a chess tournament. Lord willing and the creek don't rise, I will be doing next Thursday at this time, but this is really important. The background that you see, I will not be in this room when I do the live stream. I will be in our basement because we're having some work done on the house. This room is getting painted. Whether I will be down there permanently or will return to this space, I don't know yet. My wife will tell me what the answer to that question is, and I'm okay either way. But in some ways, the space down there is better suited because there aren't windows. I mean, we have windows in our basement, but not, and it's finished, but not where I'll be. You'll see, I guess, white wall behind me, maybe some bookcases. It's all my wife's stuff, so I'm going to have to think about redecorating. Anyway, yeah. So that's it. Sorry I couldn't get to all your questions, but we will be doing this. Oh, I see Gary asked, Rob, how do you tag your name to get a question in? I think what you do is just the @ sign, Rob, and then at least for me, I come up. It's just @ Rob space Burger. This is a test. There you go. And I come up orange. To me, I don't know what you guys see. In any event, yeah, that's how you do it. Well, listen, hope you have a great week. I do keep track of these questions, particularly ones that I don't have a clue about, like, I shouldn't say a clue, but reverse mortgages, that retirement fund. I am going to get to them as soon as I can. I'll do that. So, and you guys can remind me when a topic has gone by and I haven't responded, and, I need you guys to keep me honest. That would be helpful. Yeah. All right. Well, listen, hope you have a great week and I guess weekend. Join the newsletter if you want that sort of thing. And remember to subscribe to the YouTube channel as many times as you can so we can get to 100,000. Appreciate it. Have a good week. Remember, until next time, you didn't think I was going to say this, so I forgot. Until next time, remember, the best thing money can buy is financial freedom.